Okay, let's just get right into it. Global growth? It just suffered a massive downgrade. At the same time, over 10 million barrels of oil have effectively vanished from the daily market. And while Wall Street is completely hyperventilating over AI, the greatest wealth transfer of the decade is happening in a metal they've ignored for 10 years. This is the Q2 2026 data they really don't want you to see.
So that 3.1% global growth figure, look, that's not just some number on a spreadsheet. It's a material, painful deceleration. The IMF's downgrade is directly tied to a geopolitical shock that has slammed the brakes on the entire world's economic momentum.
And that oil shock? This isn't a forecast or some projection. In March, 10.1 million barrels per day just vanished from the global supply. This is the largest supply disruption in history, and it's happening as we speak.
So what does this all point to? It's a fundamental change in the market's rules. While all the headlines are obsessing over AI, the real story and the real wealth transfer is happening somewhere else entirely. And to understand it, you need to see that we are now fighting a war on 4 distinct fronts.
So let's start with front number 1, monetary policy. You know, the era of central banks all moving in lockstep, holding hands? Yeah, that is definitively over. We have entered a period of profound and dangerous divergence.
Think about it. Ever since the great financial crisis, we've lived in this world of synchronized monetary policy. First, it was coordinated easing, then coordinated tightening. That predictable world is gone. Today, every single major central bank is on its own, fighting a completely different battle.
And this right here, this table perfectly illustrates the chaos. You've got the Federal Reserve completely paralyzed. They want to cut rates, but they can't because of this sticky 2.8% core inflation that's been reignited by the war in Iran. The ECB, they're trapped. They had to pause their easing cycle and are now actually debating rate hikes. And the Bank of Japan, it's on a completely different planet, hiking rates right into a global slowdown.
Now, all this chaos in the monetary system is, of course, spilling over into the real world. And that brings us to front number 2, the kinetic breakdown of the world's most critical supply lines.
To really understand the stakes here, you have to know what a choke point is. We're not just talking about shipping lanes. These are the actual arteries of the global economy. 1/5 of the world's entire oil supply passes through just a single one of these channels.
And today, the supply chain isn't just bending, it's utterly broken. The Strait of Hormuz has been effectively closed since late February, and a U.S. naval blockade is now in effect. Inside the Persian Gulf, an estimated 2,000 ships are trapped, completely unable to deliver their cargo to a market that is starving for it.
Just look at this data. It's not just Hormuz. The simultaneous threat to the Bab el-Mandeb Strait by Houthi forces has created a full-blown dual-chokepoint crisis. All Asia to Europe traffic is now being rerouted around Africa, adding 10 to 14 days of transit time. This has effectively erased the world's spare shipping capacity and sent insurance premiums into the stratosphere. This geopolitical friction, it was the spark that ignited front number 3, a historic commodity supercycle. But, and this is the key, not in the assets you'd expect. We are witnessing a seismic repricing in monetary metals. The story really starts with silver. For 5 consecutive years, the silver market has been in a severe structural supply deficit. The cumulative shortfall is now approaching 820 million ounces. That is a staggering number, and it means the physical market is being squeezed from all sides.
And this quote, I think it captures the paradigm shift perfectly. Silver is no longer just a hedge against inflation. Its primary value driver has now become its indispensable role in the foundational technologies of the 21st century.
And here's exactly why. The demand is what we call inelastic. It's coming from solar panel production, EV manufacturing, and most critically, the massive electrification required for AI data centers. While Wall Street sells AI software stocks, they've completely missed the physical constraints on the actual hardware.
This brings us to the 4th and final front, a fundamental realignment of global power. The age of the petrostate is ending, and a new geopolitical model is taking its place.
To understand the next 50 years, you have to understand this concept of the electrostate. It's a nation whose power doesn't come from pulling oil out of the ground, but from mastering the entire electric stack, from batteries and motors all the way to the compute that makes them intelligent.
And the crucial point is this. While America has doubled down on its 20th century model as a petrostate, China has quietly and decisively become the world's first true electrostate. By dominating the manufacturing of this core infrastructure, Beijing has created an entirely new form of global dependency and strategic leverage. Okay, now let's bring these four fronts together. A divergent monetary system, a broken supply chain, a commodity supercycle, and a brand new geopolitical landscape. All of this converges on a single point of failure that threatens the one market everyone believes is invincible.
So the question is, what is that specific trigger? What is the one event that could unravel the entire megacap tech trade, causing a liquidity crisis that just cascades across the entire globe?
Just a quick reminder before we continue, I am an analyst providing intelligence based on the source material. This is not personal financial advice. You should always do your own research.
Okay, here it is. The catalyst is the Bank of Japan. For over a decade, the entire global financial system has been funded by cheap Japanese capital, what they call the yen carry trade. If the BOJ hikes its interest rate past a terminal rate of, say, 1.75% faster than the markets expect, it will trigger a forced repatriation of Japanese capital back home. This massive capital flight will destabilize the U.S. Treasury market, cause a sudden spike in yields, which will instantly break the valuation models of the mega-cap tech stocks that are propping up the entire market.
So how do you navigate this new reality? Because the old playbook is not only obsolete, it's actually dangerous.
That traditional 60-40 portfolio of stocks and bonds? It's dead. It was designed for a world of synchronized central banks and stable supply chains that simply no longer exists. Survival in this new era requires a portfolio built on three pillars: hard assets that can't be debased, sovereign technology that is resilient to geopolitical shocks, and uncompromised liquidity.
And that brings us to the final point. The ultimate form of liquidity and protection is not cash, which is actively being debased by central bank policy. It's physical silver and gold. They've decoupled from traditional correlations and are now being priced on sheer scarcity and geopolitical risk. JP Morgan's models now project gold could breach $6,000 an ounce by the end of the year. In a world on the brink, the most important move you can make is to protect your downside.